we're going to begin Chapter 8, which is a discussion of receivables. In our first learning objective, we're going to look at common types of receivables and how to journalize sales when they're sold on credit. So these are sales that are not for cash but for credit. We'll also look at both credit and debit card sales. We begin by thinking about the definition of a receivable. And we should, of course, understand that not all customers will be paying cash. So obviously today, most customers use credit cards and businesses will buy on account. And this means that they'll take possession. Simply, there's no formal document. An order is placed online or by phone, and the order is delivered, and they will pay later. A formal definition of a receivable is it's the right to receive cash in the future from a current transaction. So in this case, the business is selling on credit, and once they do, they have the right to receive cash in the future. Now, the credit relationship between the business and customer, of course, creates challenges for both accounting and management. And one big problem, of course, is the possibility that some of the receivables will not be collected. So uncollectible accounts or bad debts is going to be a cost of selling on credit. So once you offer credit sales, the uncollectible accounts or the bad debt should be looked at as an expense of selling on credit. Now, when we look at the accounting issues related to receivables, two things are important. Number one, how do we account for those receivables? So when we think about the receivables itself, we have to come up with an estimate of how many or what percentage of those accounts will be collectible and how much of the accounts will be uncollectible or bad debts. And then secondly, how do we report or communicate this to the users of the financial statements? So this problem of not being able to collect all of your accounts is critical in terms of measurement and communication. And we'll discuss these throughout the chapter. First, however, we want to take a look at the different types of receivables. We have accounts receivable and notes receivable. And typically, when we look at accounts and notes, these are trade accounts. Part of the normal business, other receivables are usually non-trade. So, for example, you might have a receivable from an employee. Or an officer of the company. So somebody borrows internally so that you'd have an officer or an individual borrowing. Now, the accounts receivable is the most common. And as we said, these are typically trade receivables, and they result from performing services or providing goods to customers in the normal course of your business. And the accounts receivable are typically current assets because they usually do within a 30-day period. So to summarize, when we look at our three types of accounts, and of course starting with accounts receivable first, accounts receivable, as I said, are typically trade receivables. They will result in or result from the normal course of business of providing goods and services, and they're typically 30-day accounts. Now, a note receivable also is part of the trade, typically, but usually it's when we extend credit to customers or when we convert an accounts receivable to a note receivable, and that will happen. Usually these are larger dollar amounts so that rather than having an open account that has no formal documentation, a note is used. Now, the note, as we'll see over and over again, is a formal promissory note. It's a formal document, a written promise to pay a fixed sum of money at a specified date in the future, typically with interest. So the two ways, or the two common uses of notes on this particular slide, there are actually three uses in total. The first is perhaps customer loans. The second is to convert the receivable, an accounts receivable, to a formal note receivable. And the third use is here when we think about selling large products, and here were high dollar products. So you'll see that large companies will have a finance arm or a finance subsidiary. So you have GE Credit. You'll extend credit, or GE Capital, that'll extend credit for customers, or a large subsidiary of a significant company will provide credit to their customers. So rather than borrowing from the bank directly, you'll borrow from GE Credit or GE Capital, and you will buy, in terms of buying the asset, you'll be able to provide the financing as well. And as we said, by definition, a note receivable is a formal document, a written promise to pay a specified amount in the future. And here, by the way, is where, when you think about when you finance the sale, this is where the note receivable is looked upon as a trade receivable. If you're selling very large items, such as, generators or huge components for airlines, those types of sales are generally financed by the company through a finance subsidiary, and those would be evidenced, those sales would be evidenced by notes. And this is the third way in which we use notes receivable. So number one, we use notes receivable if we lend to customers. Number two, we'll use a note if a receivable is not paid and we want more security. We'll convert the account receivable to a formal document, the note receivable, and we could also sell on credit by using notes receivable when we have a significant item that is being sold. Now, of course, the person that signs the note or that issues the note is called the maker of the note. And again, notes receivable are longer term than accounts receivable. And although some can be short term, if they are short term, they're more than 30 days. They're usually 90 or 180 days. So to summarize, our second type of receivable, the notes receivable, we said it's a formal written promise to pay a fixed sum of money at a specified due date. It will also have typically an interest rate stated, or a stated rate of interest. Doesn't have to be. It could be a zero coupon, as we'll see. It's a formal document. It's a written document to pay principal plus interest, as we said. And it's usually a longer period of time, 90 days, 3 years. If you're financing the acquisition of a product, a very expensive product, as I said, a generator. If it is a 90-day note, it's a short-term note. That's a current asset. And if it's a 3-year note, it's a long-term note. And again, these are notes receivable. Notes receivable. So once again, in summary, the notes are long-term or short-term. They are written promises to pay. They're used in 3 ways. By the way, they pay principal plus interest. They're used in 3 ways: loans, conversion of accounts to notes receivable, and to finance the sale of significant or capital items. Now, we have other receivables, of course, as I said, and these arise maybe, for unusual reasons, and sometimes they could be in the normal course of business. So when we have the dividends, taxes, interest receivable, these other receivables, this is in the normal course of business. If you happen to have a loan to an employee, that would be outside of the normal course of business. So tax refund receivables, dividends, and interest receivables, these are part of, you would expect, business. It's not part of operations, but if these are non-operating items, and again, these could be current or long-term. And again, the other reasons why you might have other receivables are loans to officers or loans to employees. And once again, loans to officers and loans to employees are outside of, I guess, what you would think of as a normal business operation. Now, we'd like to start looking at recording sales on credit. So let's go back to Smart Touch, which is our sample company throughout this textbook, and they are providing services, $5,000 to Brown on account, and sells $10,000 of inventory to Smith on account. So this is a credit offered directly to the customer. So this is Smart Touch offering credit. You're not using a credit card here. So that on August 8th, the $5,000 services were provided, and we know that these are services not involving product. $10,000 is going to result in a sale of inventory, and here we're ignoring the cost of goods sold. So to record the sale, I think we've seen this already, you would debit accounts receivable and credit sales revenue, or service revenue in this case, because this is the 5,000 services provided. And notice that now the accounts receivable is going to be matched to a particular individual. It could be by account number, and usually within a management information system, an internal computer record would be kept of the customer, typically by account number. And all of this detail is not in the general ledger. We typically have an accounts receivable subsidiary ledger. So if you were looking at this from the standpoint of a systems analyst building a sales system, a collection system, you would have to be sure that you are able to identify each receivable by a particular customer. Same thing's true with our sale of products. We now have, again, notice the difference. You have $5,000 in service revenue. You got $10,000 in sales revenue. Debit accounts receivable, credit sales. But again, we're keeping track of a separate customer account. So in a subsidiary ledger, you would be able to identify how much each customer owes you. And of course, that's going to be important because we need to track payment history, whether or not the customer is paying on time, whether or not they tend not to pay on time, and that would determine whether or not you would be willing to continue to sell or provide services to your customers. And as I said, you would obviously need to accumulate hundreds and thousands of accounts so that each customer has to have a separate account identified by account number, and collection of the individual accounts is easier, and we could track who's paying and who's not by looking at this through a separate ledger, which is called the accounts receivable subsidiary ledger, as I mentioned earlier. This is an internal document. It's not on the balance sheet. I mean, obviously on the balance sheet, it's impractical to have every customer listed separately, so that we have a separate ledger, a subsidiary ledger, that keeps the balances separate. And of course, in the general ledger, we have what is known as the control account, and that would be the total of all your receivables. So the control account is in the general ledger, and the subsidiary ledger is an internal document that's not published to the users of the financial statement. So if you notice, what will happen in practice is that the general ledger will reflect the control account for accounts receivable. That $15,000 gets reported on the balance sheet. So that's going to go, the process. If we use a worksheet, we've got the balance sheet, and then that balance sheet column on the worksheet is adjusted. The adjusted trial balance is used to prepare financial statements. So this is going to go to the balance sheet at some point. However, internally, I'm going to need to know on the subledgers, I'm going to need to know the individual accounts for each customer. Now again, this is where the company is providing its own credit. Credit could also be provided by a third party, and that's the way we kind of understand credit, is through third parties. And this is where we have both credit sales, and although debit sales are not credit, but these are third party vendor plastic sales. So the third party is actually handling the collection. So that when you talk about these plastic sales, we're dealing with both credit and debit sales. And these plastic sales, whether they're credit or debit cards from third parties, they are treated as cash sales. And there's a fee charge, and that's all we need to account for. So the credit and debit card companies charge a fee each time they process a transaction. So these third-party vendors will actually do the service of collecting, or provide the service of collecting, and that's something you don't have to worry about. So if someone comes in with a credit card or a debit card, it's like getting cash immediately, except at the end of the period, a fee is going to be charged. Now, the question that we have is, and again, the typical fee is going to be anywhere from 1 to 5% of the sale. All right, and this fee is the primary source of credit and debit card revenue for the providers or the vendors. And the two methods we can use to account for these fees are the gross or the net method. And the key point is that the sales made using credit card companies or plastic are accounted for as sales on account. The company credit cards not using outside vendors are treated as sales on account, which we illustrated earlier. So let me repeat that in the prior example, Smart Touch was providing the credit, and that's where you generate accounts receivable or notes receivable. But we saw the accounts receivable for Smith & Brown in our prior example for providing the services and the goods. Now, those are credit sales. When we have a third-party vendor, then, of course, it's going to be a cash sale. So, to summarize, when we have a third-party vendor providing both credit and debit card sales, they're recorded as cash sales. So this is critical. You do not treat these as credit sales. And the fee is charged by the credit card company, and the net amount is received. In other words, you get cash, but it's reduced by the fee. Now, of course, the question you're going to ask is, why would I sell on credit using a third-party vendor or a debit card when there's a fee and it reduces the amount of cash I receive? Well, the answer is, number one, if you have to have your own credit department, it's expensive to run, number one. Number two, you'd have, and what I mean by expensive to run is that you would have to have computer systems, you'd have to have employees that are involved with processing the sale, processing the receivable, ensuring that there's collection, following up on any uncollected accounts. So that becomes expensive administratively. Also, the other problem is that you have to wait for your cash, whereas here you get your cash immediately, so it is reduced slightly by the fee, but you're getting your cash up front. The sooner you get the cash, you could put it to use. So we'll talk about the idea of a present value, but certainly $1 received today is worth more than $1 received 30 days from now. And not only that, but you are not responsible for following up on the bad debts. So the risk of bad debt is now shifted to the third-party vendor, the plastic vendor, and therefore, if it's Chase or Wells Fargo issuing the credit card, they are now responsible for collecting, and they are going to be at a loss if the credit card balance is not paid. Now, all we need to do after recording a cash sale is to account for the fee, and the fee is accounted for either under the net method or the gross method. And we said this fee could be anywhere from 1 to 5% of the sale. So the two methods to account for the fee are called the net and the gross method. Under the net method, we record the sale net of the fee. So the fee comes off immediately when we record the sale. Under the gross method, we record the gross amount of the sale, and then we only deduct the fee when it is charged by the third-party vendor. So the gross and net method will just differ in terms of the timing. So under the net method, we're going to record the fee at the time of the sale. So let's assume that SmartTouch sells inventory to a customer for $3,000 and they pay with a credit card, and there is a 4% fee. And of course, that fee means that the credit card company will give us money immediately, but they're going to keep $120 of that amount. So they're going to keep $120, and we are going to receive the net amount. So the net cash that we get from this sale is $3,000 minus $120, or $2,880. So the journal entry we would make will depend on the method we use. Here we're using the net method. So in this case, we will record the sale in full. We credit sales revenue for $3,000. We're going to debit cash for the net amount. As I said earlier, that net amount is $2,880. And we debit an expense called credit card expense or transactions fees, and that's going to be debited for $120. Now remember, we record the net amount of cash after the fee is deducted, and we deduct the fee at the time of sale. And the net method is a method that only uses one journal entry. On the other hand, if you use the gross method, you'll have to make two journal entries. You will deduct the fee only when the fee is paid. You'll deduct the fee only when the fee is actually paid. So we record two journal entries, and again, taking the same sale by SmartTouch, merchandise inventory is sold for $3,000. It's sold on plastic, and the fee is 4%, or as we said, it's going to be $120. Now, in this case, we record the sale at the gross amount. So the fee is not recorded at the time of the sale. And notice again, we treat it under the gross method as if it is a cash sale. However, the problem is that the company assesses a 4% fee, and therefore $120 has to be paid. So at the time the assessment is made, the entry is made to debit the credit card expense and credit cash. Now, let me go over to the whiteboard and let me make sure that we understand that sales on credit can take two forms. One is company credit, and the second is third-party vendor. So we'd say credit card. Here, we record debits to accounts receivable and the credit to sales. If it was a third-party vendor, we're going to record cash. If it's the net method, so remember, third-party vendor credit card sales are treated as cash sales. And this is net. So you record the cash net, credit card expense, and sales are still the gross amount. Under the gross method, we have two entries. Record the sale, debit cash, credit sales. This is the gross amount. This is the net amount here. And the second entry is the debit credit card expense. And credit cash. Either way is correct, just there's a slight difference in your timing. And remember, if you sell it yourself through your own credit, of course, you always collect, assuming that there's no bad debts. When you do collect it, debit cash, credit accounts receivable, but the cost of doing business on credit here, unlike the credit card expense, which is fixed and determinable, here the amount of your cost of doing business on credit is uncertain. If you don't collect the full amount, then you are going to be subject to collection processes. You'd have to try to get the customer to pay, and all of that takes administrative time and expense. So the amount that you could lose on an internal credit card sale may be much greater than the assessment fee. And that's something businesses will have to decide whether or not they want to run their own credit, whether they want to chase people that don't pay on their own, or do they want to leave that up to a third-party vendor. So starting with our second objective or a second module in Chapter 8, we're going to move into the issue of how do we account for uncollectible accounts.